Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are up 51 basis points on the 1 hour chart. We are approaching overbought RSI and we are still on pretty strong positive MACD on the 4 hour chart. We're still on the positive MACD as well, and we are much closer to overbought levels on the RSI, but we have not quite hit the 80 RSI yet. And on the daily chart, we are also, or right now, we are currently touching overbought RSI on the daily chart. And we start to see a slight divergence. If you can kind of see, the gap between the MACDs are starting to get closer and closer. So we may see a divergence very soon. And we also made a all-time high today, and I would say we may see a possible fall or revert back to the mean around the price, or I should say back to the 18-day moving average. This is no way saying that we are going to make a giant reversal. We are just simply funding back support and building on that support so we can climb on higher. So at the moment, the first support that I see is the 18-day moving average. We do have a gap up in between November 1st and November 4th. So we do need to fill in that gap in order to make new higher highs. So I do see that happening in the near future. So that price movement is roughly around 1.5 or 1.6% to the downside. So the forecast model is now in the link below, so do check it out. You can check and examine the S&P 500. And if we wait a bit, all right. So if we configure the settings, we get the results of all the models that were displayed, and we can just examine the models that we see earlier in this video. So do check it out and enjoy. So back to the forecast model, I'll go day by day where the S&P 500 will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to August 28th to November 21st. 2013. So let me point out why these two charts are similar. So what we have in the beginning of the current trend, we start off below the middle Bollinger Band, or I would say near the bottom Bollinger Band. Next, we just mark all the instances where it touches the bottom Bollinger Band. And after that, let's mark where we have a nice channel to the upside, very strong, averaging above the middle Bollinger Band the entire time. So we have those two instances. So down to the trend in question, we start to see a similar pattern. First, we start off below the middle Bollinger Band or touching the bottom Bollinger Band. And there's the second one right there. Next, let's mark where it touches the upper Bollinger Band or averages above the middle Bollinger Band. So we have the first one there and the second one right towards the end. So what we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's a reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was August 28th to November 21st, 2013. Back then, the S&P 500 was only down roughly 10 basis points. So we are still most likely going to encounter sideways price action. Overall, the trend is very healthy for the broader markets. So I do see sideways price action in the next coming days. So again, this forecast model is now in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.